So the Bank of England inflation report today, released this lunchtime, hasn't really revealed any major surprises. What we've seen is the MPC shift from an 8-1 vote to a unanimous vote that rates should stay unchanged and that the level of asset purchases remain where they are. The backdrop to this inflation report has obviously been significant turmoil on financial markets and concern about slowing growth, particularly in China and other emerging markets. And really what the bank's done is reflect some of that uncertainty by downgrading its growth and inflation forecasts for the next couple of years, and essentially signalling that interest rates are very unlikely to rise in the foreseeable future. And GDP forecasts are now expected to be 2.2% this year, rising back towards trend next year, and the path of inflation isn't expected to return to the 2% target until the beginning of 2018. The interesting point to note, a couple of points. Firstly, the governor was asked specifically about whether the next move in rates might be down, or that there may be further easing in monetary policy. And in fact, the markets have been discounting a 30% chance of the next move being an ease. He refuted that, and the notes of the minutes made it very clear that the committee still expects the next move in interest rates to be up, although not for some time. The other point to note is that the backdrop of growth in nominal terms, the cash growth of the economy, is significantly weaker than it has been. This was in the latest GDP numbers, and he points out in his letter to the Chancellor that that may have a knock-on implication for tax revenues and tax receipts, which will potentially undermine the Chancellor's ability to hit his fiscal target. So overall, a softening pattern of growth, an expectation that interest rates will be on hold for longer, but not as dovish, if you like, as the markets had got to. Still a clear signal that rates will rise at some point in the next couple of years.